Hello, this is Anthony Nagle with Lowercase Capital, and today we'll talk about the earnings update for the S&P. We'll also cover the overall performance of the index in the past week, and we'll touch on the potential oil storage trade that I mentioned in the previous episode, and then we'll wrap up with my view on trading versus investing. So first on the earnings. 1,400 companies reported their numbers in the past week, with 54% hitting the mark or exceeding it, and 41% falling short, but an average result of 2 cents per share as a miss. So what that says to me is it's really consistent with the past couple of weeks. There's really no strong outliers here. It is interesting that the average result is 2 cents short, even though most companies met or exceeded their number. I don't really draw any conclusions from that. So if we move on to the S&P's performance, it's kind of a similar result. You saw the week performing a little bit strong in the beginning, and then overall it just kind of went horizontal. So where we closed this week was lower than the peak from last Wednesday. However, we are up on the week. The big thing that stood out to me is at the end of the week, the VIX closed below 30, actually down around 28. So we're really not at the point yet where I would reallocate based on the VIX level, but it's something I'm keeping a close eye on. The next thing I wanted to talk about is the potential oil storage trade that I mentioned from last week. This was a trade I first saw the idea for from a gentleman by the name of Cuppy on the Market Huddle podcast. And really the basic premise is if land-based storage for oil is full in the United States, where are producers going to go next to store their oil? They're going to look towards tankers. Tankers are going to park out in the ocean for a couple months, store that oil, and then bring it back into the market when the oversupply issue is corrected. So if you're of the opinion that there's still an oversupply, that there's still a shortage of storage capacity, this might be an interesting idea for you. Of course, do your own research on this one, just as I did, but here's what I found. So this month options expiration is May 19th, and if there was going to be an appreciation in these oil storage companies, these tanker companies, you would tend to see it towards the end of May. Going along with that, many of these companies also report earnings in that same late May timeframe. And if some of these companies have already seen excess earnings versus what they thought they were going to be getting, that's going to show up in that quarter one earnings report at the end of May. And so for me, how would I want to approach this? I would like to get into oil companies that present some type of value and that they have some good cash on hand versus their current liabilities, just to make sure there's no financial issues in the next couple of months. I would be looking to see that I'm positive after the end of May, and at that point I would be putting in some trailing stops. And if I'm negative at the end of May, I would want to hold on to this until I'm about maybe minus 10% or so, or once we get into the June futures contract expiration. At that point in June, at least in my opinion, the way I'm looking at the situation, I would want to get out. I don't want to go any further beyond that as a trade, and I don't necessarily want to get into these tanker companies long term. So for me, this is just a potential trade. It's an interesting one, and full disclosure here, I don't typically do a lot of trades. I'm more of a systematic investing type of a person, and so putting this trade on yesterday was actually an interesting thing, yesterday being Friday. So we'll see how this one goes. And that brings me to the last topic of the day, trading versus investing. So what is a trade to me? It's a specific reason why I believe I can make money in the short term on some company, sector, the index overall, whatever investment it is that I'm considering. I have a specific reason and a specific time frame in mind. And so how do I go about putting that position on? Well, first I need to write all this stuff down so I can hold myself accountable. I will tell myself, this is why I expect to make money. This is the conditions I need to see before I enter the trade. And these are the steps along the way that would cause me to either adjust my position size or get out of my trade, either on the positive or the negative. If you have all of those elements in place, or if I have all those elements in place, I'm willing to put the trade on. And until I have those, I don't want to do it. Now, an investment, on the other hand, I don't have a specific exit point because I'm holding that strategy over the long term. Now, the holdings inside of that strategy may change, but let's say, for example, I'm operating a value strategy. I want to have on at least 10 to 20 companies in there, and I want to have companies that I believe are going to perform better than the average value company. And that's the idea. And so what's the difference there? With a trade, I know that there's information that I don't have. I don't know everything about tanker companies as a whole. I don't know why it's the case that a lot of them trade at negative price to book on a regular basis. To me, that's very strange. But fine, it's not a sector that I specialize in. But I'm willing to go in there for a specific reason for a specific period of time. What I'm saying is I know there's limitations to my knowledge, and as a result, I need to set myself up some strict rules so that I don't get into trouble, or at least that I can limit the trouble that I get into. I like to close this topic of trading versus investing with a gaming analogy. So to me, trading is a lot like playing StarCraft. It's a real-time strategy game, which means that you have to have, before the game starts, you have to have a strategy in mind. You have to have a plan of attack. You have to have action points and correction points in the way that you're going to play that match. And it's a time-sensitive thing. Okay, if I am clicking in real time, and if I do something wrong in execution, it's going to cause a problem. It's the same thing with trading. We're watching the price action go. You have to find the right moment to put the trade on, and there can be execution errors. They're just the same. And so what do I compare that against? To me, investing is a lot like civilization. So instead of a real-time strategy game, now I have a big picture turn-based game where I can survey the land, I can develop a complex strategy in advance, but I can adapt it turn by turn as I see the information, and there's not a time crunch there. I can take hours if I wanted to, although that would be horrible. But you get the idea, right? So investing is really all about the idea that I have a big picture, and it's not about the details of execution. It's about getting the concepts right. Versus trading, it's a lot more dependent upon your execution as well as getting the concepts right. And so there's a certain discipline that's required with trading. So what are we going to talk about next week? Gold, currencies, treasuries, and the US dollar. So right now the market is really... So what are we going to talk about next week? Gold, treasuries, and the US dollar. Right now the S&P is at a level similar to where it was at the start of this week. And so we need to know if the market's continuing up, if that signals maybe a change in direction, maybe we're due for new all-time highs. And if that's the case, at least for myself, I need to reassess how I want to allocate myself within that currency space. So again, it's Anthony Nagle with Lowercase Capital. And I just want to mention real quickly, this video is intended for informational and educational purposes only. This is not investment advice. Before making financial decisions, please consult with an industry professional. Please consult with a financial professional. Thank you.